On a quiet Tuesday in Brussels, something happened that will reshape your life in ways you don't yet understand. No explosions, no declarations of war, just signatures on paper. And with those signatures, the financial architecture that has defined global power for 8 decades began its collapse. What I'm about to show you isn't speculation. It's not theory. It's a documented $890 billion trade agreement between the European Union and India that has been deliberately structured to function entirely without the US dollar. Not reduce its use. Not minimize dependence. Eliminate it. And if you think this is just another diplomatic handshake that doesn't affect you, you're not paying attention. This is the moment historians will point to when they explain how American economic dominance ended, not with a bang but with a signature. Right now, as you're listening to this, there's a quiet revolution happening in the world of international finance. European companies are transferring euros directly to Indian manufacturers. Those euros are being converted to rupees in seconds. Payments are clearing. Goods are moving. Trade is flowing. And not a single dollar is touching any of it. No American banks involved, no New York clearing houses, no SPUF codes routing through U.S. financial institutions. It's as if the American financial system simply doesn't exist. And here's the terrifying part: this isn't a glitch. This is the design. This is the blueprint. And it's expandable. Think about what that means. For 70 years, if you wanted to buy oil from Saudi Arabia, you needed dollars. If you wanted to purchase electronics from China, somewhere in that transaction chain, dollars were involved. If you wanted to trade wheat, copper, pharmaceuticals, or aircraft parts, you passed through the dollar system. That gave the United States something more powerful than aircraft carriers or nuclear weapons. It gave America control over the rails that global commerce runs on, the ability to see every transaction, to approve or deny access, to freeze assets with the stroke of a pen, to essentially decide who gets to participate in the global economy and who gets cut off. But what happens when the second largest economic bloc on Earth and one of the fastest growing economies in Asia build a highway around those rails? What happens when they create a system so efficient, so fast, so cost-effective that other countries start asking, why are we still using the old system? That's not a hypothetical question. That's what's happening right now. You need to understand this, not because it's interesting geopolitics, not because it makes for dramatic headlines, but because this directly impacts your purchasing power, your job security, and your financial future. When the dollar loses its status as the mandatory global currency, demand for dollars decreases. When demand decreases, value erodes. And when value erodes, everything you buy from abroad becomes more expensive: your iPhone, your clothes, your fuel, everything. We're not talking about abstract economic theory here. We're talking about the price you pay at the pump next year, the cost of your groceries in 2 years, the value of your savings account in 5 years. And here's what they're not telling you in the mainstream financial press: this isn't reversible. You can't sanction your way out of this. You can't threaten your way out of this. Because the leverage that made those tools effective was dollar dependency. And that dependency is exactly what's being dismantled, piece by piece, deal by deal, one digital transaction at a time. The European Union and India didn't hold a press conference announcing we're destroying American financial hegemony. They didn't need to. They just built the alternative. They laid the infrastructure. They signed the contracts. They moved the money. And by the time Washington realizes what's happening, the system will already be operational, already expanding, already recruiting new members. So if you want to understand why your cost of living is about to change, why your government's ability to borrow is about to get more expensive, and why the world your children inherit will look fundamentally different from the one you grew up in, you need to stay with me. Because what I'm about to reveal isn't just about trade deals or currency swaps. It's about the end of an era, and the beginning of something none of us are prepared for. Let me take you inside a room that most people will never hear about. December 2024, a conference hall in New Delhi. No cameras allowed, no live streams, no tweets from inside. Just European trade ministers, Indian commerce officials, and a stack of documents that would permanently alter the balance of global power. What was signed that day wasn't just a trade agreement. It was a declaration of financial independence. And the country they were declaring independence from didn't even know it was happening. Here's what the official press release said: the European Union and India have concluded negotiations on a comprehensive trade and economic partnership agreement valued at €890 billion over 10 years, focusing on clean energy, digital infrastructure, pharmaceutical cooperation, and mutual market access. Sounds boring, right? Sounds like every other trade deal you've scrolled past. Standard diplomatic language. Progressive buzzwords. The kind of announcement that gets buried on page 12 of the Financial Times. But buried in the technical annexes, in the sections that financial journalists don't usually read because they're written in the language of central bankers and trade lawyers, there's a clause. Actually, there are several clauses. And together, they represent the most significant challenge to dollar dominance since the Bretton Woods Agreement in 1944. The key provisions establish something called the Euro-Rupee Digital Settlement Mechanism. That's the official name. Here's what it actually means: a completely independent payment infrastructure that allows European and Indian businesses to transact directly in their own currencies without ever touching the US dollar or passing through American financial institutions. Let me break down exactly how revolutionary this is. Under the current system, if a German pharmaceutical company wants to buy active ingredients from an Indian manufacturer, here's what happens. The German company converts euros to dollars through a European bank. Those dollars get transferred through correspondent banks in New York. The correspondent banks route the payment through the SWIFT system, which is monitored by the US Treasury. The dollars arrive at an Indian correspondent bank. That Indian bank converts the dollars to rupees. The Indian manufacturer finally receives payment. This process typically takes 3 to 5 business days. At each step, there are fees. At each step, there's currency risk. And at each step, there's exposure to American regulatory oversight, which means compliance with U.S. sanctions policy, U.S. anti-money laundering rules, and U.S. foreign policy objectives, whether the German or Indian company agrees with them or not. Now, under the new EU-India system, the German company initiates a payment in euros through the digital platform. The platform instantly converts euros to rupees at a pre-agreed exchange rate. The Indian manufacturer receives rupees directly. The entire transaction completes in minutes. No dollars, no New York, no SWIFT codes, no American banks extracting fees, no Treasury Department monitoring the flow, no compliance with Washington's geopolitical agenda. The efficiency gain alone is staggering. But efficiency isn't the real story here. Control is the story. For the first time, 2 major economies have built financial infrastructure that makes American participation optional rather than mandatory. Not difficult, not expensive, optional. As in, we don't need your permission anymore. The immediate economic impact is significant. We're talking about €890 billion worth of trade over a decade. That's not a small regional agreement. That's nearly €1 trillion of commerce that will flow through channels where the dollar is simply absent. But the real impact isn't the initial volume. It's the precedent. It's the proof of concept. Because here's what other countries are seeing. If the European Union, America's closest ally outside of the Anglosphere, and India, Washington's preferred counterweight to China, can build a system that bypasses the dollar, then anyone can. The technical barriers aren't insurmountable. The political barriers aren't insurmountable. The only barrier was belief. The belief that the dollar system was inevitable, permanent, unchallengeable. That belief just died in a conference room in New Delhi. And there's another layer to this that makes it even more dangerous to American interests. The agreement explicitly allows for third-party integration. It's designed to be expandable. The digital platform isn't a closed loop between Brussels and New Delhi. It's architected to accept other currencies, other central banks, other trading blocs. Indonesia could plug in. South Africa could plug in. Brazil could plug in. Saudi Arabia could plug in. Imagine a network where ASEAN nations trade with Europe without dollars, where African economies settle commodity exports in euros or yuan or their own digital currencies, where Middle Eastern oil producers accept payment in a basket of currencies managed through this platform. What starts as a bilateral agreement can very quickly metastasize into a multilateral alternative financial architecture. And once that network reaches critical mass, once it handles, say, 30 or 40% of global trade, the dollar stops being necessary. It becomes one option among many. And that's when the real erosion begins. Here's the thing that keeps me awake at night. This was predictable. Economists warned about this exact scenario for years. Former Treasury officials, international relations scholars, even some clear-eyed policymakers in Washington said the same thing over and over. If you weaponize the dollar's privilege, you will lose it. If you use financial access as a geopolitical cudgel, countries will build alternatives. If you turn money into a weapon, people will seek shelter. But those warnings were ignored, because in the short term, weaponizing the dollar felt powerful. Freezing Russian central bank assets felt satisfying. Cutting countries off from SQF felt like leverage. Using sanctions as a substitute for diplomacy felt efficient. Until it wasn't. Until the targets of those sanctions started comparing notes. Until they realized they all had the same vulnerability, dependence on a system controlled by a country whose foreign policy was becoming increasingly erratic and whose willingness to use financial coercion was becoming increasingly casual. The EU-India deal is the consequence of that realization. It's not anti-American in the sense of hostility or anger. It's post-American in the sense of moving on. It's the financial equivalent of saying, we appreciate what you built, it served us well for decades, but we can't afford to be dependent on a partner who might cut us off the moment our interests diverge, so we're building our own infrastructure, not to hurt you, just to protect ourselves. And that's actually more dangerous than hostility, because you can negotiate with an enemy, you can reach detente, you can find common ground. But you can't negotiate with irrelevance. You can't bargain your way back into a system that no longer needs you. Especially when the alternative system offers tangible benefits, faster transactions, lower costs, freedom from political interference. So the question isn't whether this is happening. The signatures are real. The infrastructure is being built. The transactions are beginning to flow. The question is, how did we get here? What did Washington do or fail to do that made America's closest allies decide they needed an exit strategy from the dollar system? Let me tell you a story about trust. For decades, the United States made a promise to the world. The promise was simple: the dollar is neutral. American financial infrastructure is reliable, stable, apolitical. You can hold dollars in your reserves without worrying that they'll be weaponized against you. You can route transactions through New York without fear that access will be revoked for political reasons. The system is bigger than any one administration, any one policy, any one geopolitical dispute. That promise held for a long time. Through the Cold War, through regional conflicts, through economic crisis, the dollar remained relatively insulated from the messiest parts of American foreign policy. Sure, there were exceptions. Cuba, Iran, North Korea. But those were pariah states, regimes that had fundamentally broken with the international order. The use of financial sanctions against them seemed justified, proportional, contained. But something shifted in the 2010s and accelerated dramatically in the 2020s. The financial crisis of 2008 shattered confidence in American financial institutions. The aggressive use of sanctions became routine rather than exceptional. And then came the freezing of Russian central bank assets after the invasion of Ukraine. That was the moment everything changed. Now, let me be clear. I'm not defending Russia's actions. The invasion was illegal, brutal, unjustified. But from a purely financial perspective, what the United States and its allies did was unprecedented. They didn't just sanction Russian oligarchs or specific entities. They froze the foreign reserves of a major economy's central bank. Reserves that had been accumulated precisely as insurance against external shocks. Reserves held in dollars and euros specifically because those were supposed to be safe, neutral stores of value. European leaders watched that happen and asked themselves an uncomfortable question. If Washington can do this to Russia today, what's stopping them from doing it to us tomorrow? Not because Europe is an enemy, obviously, but because dependence itself is a strategic vulnerability. What if there's a major policy disagreement? What if a future American administration decides to use financial access as leverage over European climate policy, defense spending, trade regulations, or tech oversight? It sounds paranoid until you remember that the United States has a history of extraterritorial enforcement of its laws. American regulators have fined European banks billions of dollars for violating U.S. sanctions, even when those banks were operating legally under European law. The message was clear: if you want access to the dollar system, you play by American rules, not your own. India had its own reasons for wanting alternatives. Delhi has faced pressure from Washington over everything from trade imbalances to foreign policy independence. They're buying oil from Russia despite Western sanctions. They're building partnerships with China even as they compete with them militarily. India is playing what they call strategic autonomy, a fancy term for not being anyone's junior partner. And strategic autonomy requires financial flexibility. So when European officials approached their Indian counterparts with a proposal to structure a massive trade deal in euros and rupees, using a new digital settlement mechanism that bypassed the dollar entirely, India didn't hesitate. This wasn't about ideology, this was about options. And in a world where financial access can be turned on and off like a light switch, options are power. The technical architecture they designed is actually brilliant. It's not just a currency swap agreement, which countries have been doing for years. It's a complete parallel infrastructure. Think of it as a financial highway that runs from Brussels to Mumbai without passing through New York. Transactions clear in real time. Currency exchanges happen automatically through a distributed ledger system. No correspondent banks needed. No SWIFT codes. No American oversight. And here's where it gets really interesting. The system uses a hybrid of technologies. It's not pure blockchain, which would be too slow and energy intensive for the transaction volumes they're targeting. It's not purely centralized, which would create a single point of failure and control. It's a federated system where European and Indian central banks maintain nodes that validate transactions, with cryptographic security ensuring that no single party can manipulate the records. The beauty of this design is that it's inherently expandable. Adding another country doesn't require rebuilding the system. It just requires integrating their central bank's node into the network. The more countries that join, the more valuable the network becomes. It's the same network effect that made the dollar system so dominant in the first place, except now it's working in reverse. Let me paint you a picture of what this looks like in practice. It's January 2026. A French automaker needs to purchase steel components from an Indian supplier. Under the old system, this would involve multiple currency conversions, several days of processing time, and fees at every step. Under the new system, the French company logs into the EU-India trade portal, initiates a payment in euros, and within minutes, the Indian supplier sees rupees in their account. The exchange rate was locked in at the moment of transaction. The total fees amount to a fraction of what they would have paid before. And most importantly, there's no American bank in the middle taking a cut or monitoring the transaction for compliance with U.S. policy. Now multiply that efficiency across hundreds of thousands of transactions. Billions of euros worth of trade moving faster, cheaper, and without American intermediation. That's not just a cost saving. That's a competitive advantage. And competitive advantages spread. Other European companies notice. Other Indian companies notice. Companies in other countries notice and start asking their governments, why can't we have access to this system? This is how revolutions happen in international finance, not through dramatic announcements or coordinated attacks on existing systems, through the gradual accumulation of small efficiencies that make the old way of doing things obsolete. The dollar didn't become the global reserve currency because the United States forced it on the world. It became the reserve currency because it was more convenient, more stable, and more widely accepted than the alternatives. Now, that same logic is working against it.